'Tis the season for tax planning. This is the Issues Watch podcast. Hello, and welcome to the Issues Watch podcast. My name is Nicole DeRosa, Senior Tax Manager at Wisdom Company, and I am very excited to be your host for the tax episodes. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of the NJCPA or of Wisdom Company. So let's get into it, shall we? Starting on the individual side, let's begin with the net investment income tax. An additional 3.8% net investment income tax applies on all net investment income above certain thresholds. For 2021, net investment income does not apply to individuals where income is derived in the ordinary course of a trade or business in which the taxpayer materially participates. Similarly, gain on the disposition of trade or business assets attributable to an activity in which the taxpayer materially participates is not subject to the investment income tax either. The November 3rd version of the Build Back Better bill would broaden the application of the net investment income tax. Under the proposed legislation, the net investment income tax would apply to all income earned by high income taxpayers unless certain income is otherwise subject to self-employment or payroll tax. For example, high income pass-through entity owners would be subject to the net investment income tax on their distributed share of income or gain that is not subject to self-employment tax. In conjunction with other tax planning strategies that you might already be implementing to reduce income tax or to perhaps reduce capital gains tax, impacted taxpayers may want to consider the following two tax planning ideas to minimize their net investment income tax liabilities. 1, defer net investment income tax for the year, and 2, accelerate into 2021 income from pass-through entities that would be subject to the expanded definition of net investment income under the proposed tax legislation. Moving along, let's talk about retirement contributions. Individuals may want to maximize their annual contributions to qualified retirement plans and IRAs while keeping in mind the current proposed tax legislation that would limit contributions and conversions and require RMDs beginning in 2029 for large retirement funds without regard to the taxpayer's age. The maximum amount of elective contributions that an employee can make in 2021 to a 401k or a 403b plan is $19,500, $26,000 if age 50 or over, and the plan allows catch-up contributions. For 2022, these limits are $20,500 and $27,000 respectively. The Secure Act permits a penalty-free withdrawal of up to $5,000 from traditional IRAs and qualified retirement plans for qualifying expenses relating to the birth or adoption of a child after December 31st, 2019. The $5,000 distribution limit is per individual, so a married couple could in essence each receive $5,000. Individuals are also now able to contribute to their IRAs in or after the year in which they turn 70 and a half under the Secure Act. The Secure Act also changes the age for required minimum distributions from tax qualified treatment plans and IRAs from age 70 and a half to age 72 for individuals born on or after July 1st, 1949. Generally, the first RMD for such individuals is due by April 1st of the year after the year in which they turn 72. Individuals 70 and a half or older can donate up to $100,000 to a qualified charity directly from a taxable IRA. Small businesses can contribute the lesser of either 25% of an employee's salaries or an annual maximum set by the IRS each year to a simplified employee pension plan, known as a SEP, by the extended due date of the employer's federal income tax return for the year that the contribution is made. The maximum SEP contribution for 2021 is $58,000. The maximum SEP contribution for 2022 is $61,000. The calculation of the 25% limit for self-employed individuals is based on a net self-employment income, which is calculated after the reduction for certain items, such as self-employment taxes. 2021 could be the final opportunity to convert non-Roth after-tax savings in qualified plans and IRAs to Roth accounts if legislation passes in its current form. Proposed legislation would prohibit all taxpayers from funding Roth IRAs or designated Roth accounts with after-tax contributions starting in 2022, and high-income taxpayers from converting retirement accounts to attributable pre-tax or deductible contributions to Roths starting in 2032. Proposed legislation would also require wealthy savers of all ages to substantially draw down retirement balances that exceed $10 million after December 31st, 2028, which potential income tax payments on distributions. As account balances approach the mandatory distribution level, extra consideration should be given before making an annual contribution. Charitable contributions. Taxpayer Certainty and Disaster Relief Act of 2020 extended the temporary suspension of the AGI limitation on certain qualifying cash contributions to publicly supported charities under the CARES Act. As a result, individual taxpayers are permitted to take a charitable contribution deduction for qualifying cash contributions made in 2021 to the extent such contributions do not exceed the taxpayer's AGI. Translation: you can offset your AGI dollar for dollar by certain cash contributions. Any excess carries forward as a charitable contribution that is usable in the succeeding 5 years. Contributions to non-operating private foundations or donor-advised funds are not eligible for the 100% AGI limitation. The limitations for cash contributions continue to be 30% of AGI for non-operating private foundations and 60% of AGI for donor-advised funds. The temporary suspension of the AGI limitation on qualifying cash contributions will no longer apply to contributions made in 2022. Contributions made in 2022 will be subject again to that 60% AGI limitation. So tax planning around charitable contributions might include maximizing 2021 cash charitable contributions to take advantage of that 100% AGI limitation, deferring large charitable contributions to 2022 if the taxpayer would be subject to the proposed individual surcharge, creating the funding of a private foundation, donor advised fund, or charitable remainder trust, or donating appreciated property to a qualifying charity to avoid long-term capital gains tax. Estate and gift taxes. The November 3rd version of the Build Back Better Act does not include any changes to the estate and gift tax rules. For gifts made in 2021, the gift tax exclusion is $15,000, and for 2022, it is $16,000. For 2021, the unified estate and gift tax exemption and generation skipping transfer exemption is $11,700,000 per person. And for 2022, the exemption is $12,060,000. All outright gifts to a spouse who is a U.S. citizen are free of federal gift tax. However, for 2021 and 2022, only the first $159,000 and $164,000 respectively of gifts to a non-U.S. citizen spouse are excluded from the total amount of taxable gifts for the year. All right, let's switch gears to the business side of things and talk about bad debts and worthless stocks. Given the economic challenges brought about by COVID-19 pandemic, businesses should evaluate whether losses may be claimed on their 2021 returns related to worthless assets, such as receivables, property, or 80% owned subsidiaries of other investments. Bad debts can be wholly or partially written off for tax purposes. A partial write-off does require conforming reduction of the debt on the books of the taxpayer. A complete write-off requires demonstration that the debt is wholly uncollectible as of the end of the year. So evaluate those bad debts. It might actually create an NOL. Talking about NOLs, net operating losses are valuable assets that can reduce taxes owed during profitable years, thus generating a positive cash flow impact for taxpayers. Businesses should make sure that they maximize the tax benefits of their NOLs. Make sure the business has filed carryback claims for all permitted NOL carrybacks. The CARES Act allows taxpayers with losses to carry those losses back up to 5 years when the tax rates are higher. Taxpayers can still file for tentative refunds of NOL originating in 2020 within 12 months from the end of the taxable year. So get them in by 12/31/2021. And get those refunds back. They might take a little while, but get those refunds, tentative refund claims in. And last, but certainly not least, make sure you're claiming available tax credits. There are a variety of tax credits and other incentives to encourage employment, investment, typically targeted towards industries such as innovation, technology, renewable energy, and low-income or distressed communities. Many state and localities also offer tax incentives. Businesses should really make sure they're claiming all available tax credits for 2021 and also begin exploring new tax credits for 2022. The employee retention credit is a refundable payroll tax credit for qualifying employers that have been significantly impacted by COVID-19. Employers that received a Paycheck Protective Program loan can still claim the ERC, but the same wages cannot be used for both programs. No double dipping allowed. The Infrastructure Investment and Jobs Act signed by President Biden on November 15th retroactively did end the ERC on September 30th of 2021 for most employers. However, that does not preclude you from going back and amending those payroll tax returns to reap this benefit if eligible for Q1, Q2, and Q3. Businesses that incur expenses related to qualified research and development activities are also eligible for the federal R&D credit. Perhaps consider an R&D study to ensure no money is left on the table for your client and they're maximizing their credit. So, in closing, I'd like to highlight a couple of upcoming NJCPA events that you might be interested in. On December 21st, the AICPA's annual federal tax update will provide info on the latest tax developments. And on January 6th, the Society's Bergen chapter will be holding an in-person event in Paramus titled Multi-State PTE Tax Update NNJB. Go to njcpa.org/events for more information on these and other events. Also, I recommend that you join the NJCPA federal taxation and/or state taxation interest groups by going to njcpa.org/groups. Thanks for joining us. We'll be back with a new tax episode soon. You can access all IssuesWatch podcast episodes at njcpa.org/podcast. Happy holidays.